Welcome back to the Deep Dive. Today we're looking at a company that is just the ultimate investment paradox. We're talking about Lucid Group, ticker LCID.
It really is a story of two warring ideas. On one hand, you have this engineering marvel that has basically conquered the laws of physics for electric vehicles.
And on the other, you have a company that seems to be in a losing battle with the laws of economics. It's a total conflict.
That paradox is exactly the lens for this audit. We're using data as of December 2025, and what we found is, well, it's pretty stark. You have objectively superior technology. I mean, world-class.
But the stock price,
Yeah.
valuation, it's screaming a warning, isn't it?
It's screaming survival is not guaranteed. Yeah.
Okay, so let's unpack that because this is a really strange situation. Usually we're looking at, a clear growth story or maybe a deep value play. Lucid is stuck in this weird high-stakes middle ground.
It is.
And it brings up something we've been calling the Buffett fear. Is it possible for a product to be, too good for its own economic health?
That's the core question. They are creating an incredible amount of what economists call consumer surplus. The person buying the car gets immense value.
At the expense of producer surplus.
Exactly. The profit for the shareholders just isn't there. And if you take a disciplined, Warren Buffett-style approach to Lucid in late 2025, the decision is instant.
He wouldn't touch it.
An emphatic, unqualified no. It violates everything he looks for. The reliance on outside cash, no pricing power, the capital intensity.
Okay.
It's just a non-starter.
And this is the paradox again. That same financial distress, when you pair it with that world-class tech, that's what makes it a magnet for a totally different kind of person.
The distressed asset speculator, they aren't betting on the current business. They're betting on a lifeline, a bailout, basically.
And that bet is so much harder to make right now, given the macro environment.
Oh, absolutely. We have to set the stage here. As of December 2025, the 10-year Treasury yield is sitting at 4.09%. The zero interest rate party of 2021 is long over.
So those distant promises of future profit.
They get discounted heavily. And the cash you need to burn to get there is incredibly expensive. It's just financial gravity pulling down on a company like Lucid.
So our mission today is to use a detailed value audit, looking at the company after its reverse stock split, to show you precisely why the value investor runs away, but the speculator, well, they might just be tempted. Part 1, Chapters 1 to 3, Business, Management, and Financials.
Yeah.
Chapter 1, Business Understanding. To really understand the investment case here, or the lack of one, we have to start with this fundamental disconnect. They have arguably the best EV tech on the planet.
Right.
But it's housed inside a, frankly, disastrous economic structure.
The problem isn't the car. It never was. It's the business model built around that car.
Yeah.
This is where we have to apply that classic Buffett idea, the difference between a franchise and just a business.
The franchise has a moat. It has pricing power.
Exactly. It's a superior product that can actually capture the value it creates. A business is more of a commodity, always fighting for margin.
And Lucid is stuck somewhere in the middle, which feels like the worst place to be.
It's the most dangerous place. They have this product, the Lucid Air, that is, technically superior in almost every way.
Highest efficiency ever made.
Right. But at the same time, they have zero pricing power and these just profoundly negative returns on capital. That's the trap. They can't turn engineering genius into profit.
And the market sees it. The judgment is brutal.
Devastatingly clear. Our analysis shows the stock trading at $13.63. That's after a 1-for-10 reverse stock split back in August.
So pre-split, that's what, $1.36?
About that, yeah. $1.36. And what the market is saying with that price is that the entire company is worth less than the cash it's burned through in the last 2 years just trying to get cars off the line.
So let's talk about the tech, because that's their only real moat. This wasn't just a random idea to build a luxury car.
Not at all. Their roots go way back to 2007. The company was called Atieva.
And they weren't building cars then.
No. They were a specialized battery and drivetrain tech provider, pure technology.
And they proved it in a very high-stress environment.
The highest. They supplied battery packs for Formula E racing. That's the ultimate test bed. You're talking about thermal management, energy density, weight. Everything is pushed to the absolute limit.
And that's where they got this efficiency-first DNA.
It was forged there. And then Peter Wallinson comes in around 2013 and convinces them to pivot, to build a whole vehicle. But that core idea, what you call the efficiency arbitrage, that stayed.
Let's break that down, because it's key. The core problem for EVs is the weight spiral. Yeah.
It's the fundamental problem. You want more range, so the simple answer is, well, just add more battery cells.
But the cells add weight.
Which requires a heavier frame, bigger brakes, stronger suspension, which then requires even more battery cells to go the same distance. It's this vicious, self-defeating cycle of cost and weight.
And Lucid broke that cycle.
How?
It wasn't just a better battery cell.
No, it was holistic engineering. They miniaturized and integrated the entire powertrain. So that's the motor, the gearbox, and the inverter all in one hyper-compact unit.
Their motors are famously small and powerful.
Lighter and more power-dense per kilogram than anything else out there. Proprietary copper winding, just brilliant engineering.
And the inverters, using silicon carbide.
Which is way more efficient at converting DC to AC power. By putting all those pieces together so tightly, they achieved this huge breakthrough.
And the result for the customer is you get 500 miles of range from a battery pack that's smaller and lighter than what a competitor needs to get 400 miles.
Exactly. And now connect that to the financials. This is where the theory was supposed to make them rich.
Right. A smaller battery pack should mean the lowest bill of materials, or BUM, cost. The battery is the most expensive part of the car.
By far.
So logically, once they hit scale,
Once they absorb all those fixed factory costs.
Lucid should have the highest gross margins in the entire industry. That is the bull case.
That's the bull case in one sentence. It's elegant physics. But the reality in late 2025 is that scale is, well, it's a mirage. They're nowhere near it.
And it's not just the battery cost, is it?
No. They're also struggling with the cost of all the other high-end parts. Custom aluminum chassis, advanced sensors, all the luxury interior stuff.
Right.
None of that is commodity. It all drives the bottom up.
Let's look at the product portfolio that was supposed to deliver that scale. You have the Lucid Air sedan. It's the technological flagship.
It proves their point. It's the longest range EV out there, but
Launching a sedan first in an SUV world was a massive strategic error.
a huge one. It was a classic Halo product. It got them a lot of hype and awards, but it didn't generate the volume or the cash flow they desperately needed. It's fighting for scraps in a shrinking market segment.
Which makes the Gravity SUV the absolute make-or-break product. And it should have been here years ago.
It's the vehicle that's supposed to fix that mistake. It's a 3-row SUV designed for 7 actual adults that still has hypercar performance.
And the early reviews are incredible.
Ecstatic. People are calling it maybe the best electric SUV ever made, but that excellence comes at a staggering financial cost.
And this brings us back to that one quote that just stings. Lucid Gravity proves that EV brands can do amazing things if you're willing to sacrifice profit.
That one line summarizes the entire problem. They create this massive consumer surplus, a phenomenal car, but it comes at the total expense of producer surplus. There is no profit for the manufacturer. It's unsustainable.
The numbers bear that out. Q3 2025 production was, what, under 4,000 vehicles?
A mere 3,891 units. That's a mix of the Air and some of the very early Gravity builds. And their factory, AMP1 in Arizona, is built for way, way more than that.
And that low utilization is the anchor dragging them down.
It's a killer. Every car that rolls off the line is carrying this huge burden of fixed costs. The building, the robots, the staff. It just destroys the unit economics.
So if there's any hope, it has to be the midsize platform, the $50,000 car.
That is the only path forward. It's scheduled for late 2026, targeting that, $48K to $50 mass market.
And this is where that efficiency arbitrage thesis really comes into its own, right?
It's amplified. Think about it. In a cheaper car, the battery is a much bigger percentage of the total cost, maybe over 40%.
So Lucid's ability to use a smaller, cheaper battery for the same range gives them a much bigger cost advantage in a $50 K car than it does in a $150 K car.
Precisely. The logic is totally sound. The problem is surviving the valley of death until then. They were burning hundreds of millions every quarter just to get to that launch.
And it's made even harder by their manufacturing footprint, this bihemispheric strategy.
It's so complex. They have AMP1 in Arizona and AMP2 in Saudi Arabia.
And AMP2 isn't there for efficiency. It's a requirement.
It's a geopolitical necessity. It was dictated by their majority shareholder, the PIF. It started as a kit assembly plant.
Semi-knockdown, or SKD.
Right. But now in 2025, it's moving to complete unit buildup. The logistical complexity is it's massive. They're shipping individual parts halfway around the world.
So why do it? It's the geopolitical tax.
That's the price they pay for the subsidy. The PIF needs Lucid to be a cornerstone of their Vision 2030 plan to build a local auto industry.
And in return, Lucid gets a guaranteed order.
A huge one. The Saudi government has committed to buying up to 100,000 vehicles. It's a massive backstop, but it comes at the cost of operational efficiency today.
So the business model is they're a brilliant tech company trapped in the body of a struggling car company.
That's a perfect way to put it. They built the world's best powertrain, but the cost of putting the fancy leather seats and the metal shell around it is bankrupting them. Chapter 2. Management evaluation. When we look at management, we use that Buffett checklist: intelligence, energy, and integrity. And Lucid's story here is really a tale of two different eras.
The first being the Rawlinson era. Peter Rawlinson, the visionary, the product guy.
Absolutely. He was essential. He had the engineering intelligence and just this relentless energy. He's the reason the technology is so good.
But his time as a public company CEO was troubled.
That's putting it mildly. He had profound failures of execution and, you could argue, of integrity with the market. His biggest flaw was just constantly overpromising and underdelivering.
The production guidance misses were shocking.
I mean, 2022 was the worst. He guided for 20,000 vehicles. They delivered, a little over 6,000, a fraction of the promise. And when you do that over and over, you just destroy credibility.
And his pay package didn't help.
It was a governance disaster. He was awarded hundreds of millions in stock tied to these market cap milestones that just evaporated. The stock cratered, but the perception was that the CEO got rich on promises the company couldn't keep.
So inevitably, a change had to be made. February 2025, he steps down as CEO.
Right. He transitions to strategic technical advisor. That's corporate speak for we need your brain, but we can't let you run the company anymore. The board, which is really the PIF, lost faith in his ability to manage a P&L.
So the visionary is out and the operator's in.
The interim operator, Mark Winterhoff, he was the COO. And he is the complete opposite of Rawlinson. He's not a celebrity founder. He's a logistics and execution guy.
And the tone from the company changed overnight.
Instantly. No more hyperbolic comparisons to Tesla. The language became sober, realistic.
He started talking about liquidity runways and cost optimization.
Yes, exactly. A vital shift towards candor. He's focused on the nuts and bolts. And that honesty, while painful, is what investors needed to hear.
We saw that in November 2025 when he cut guidance.
He did. He cut the full year production target down to 18,000, 20,000. The stock got hammered, of course, but it was the right move. It's so much better to guide low and beat it than to constantly miss an ambitious target.
And he restructured the organization too.
Correct. Consolidated power, streamlined decision-making. All moves designed to speed up development for that critical mid-size platform.
But no matter who the CEO is, we have to talk about the sovereign shadow, the PIF.
It overrides everything. The Public Investment Fund of Saudi Arabia owns about 60% of the company. That is the single most important fact about Lucid.
And the chairman of the board is from the PIF.
Turkey Onawazer, deputy governor. And he serves two masters. He needs a financial return for the fund, but he also has this strategic mandate for Vision 2030 to build an auto industry in Saudi Arabia. Those two goals are not always aligned.
Which leads to that geopolitical tax we mentioned.
Yeah.
I mean, is there a risk they force Lucid to make decisions that actually hurt other shareholders, like selling cars at a loss in Saudi Arabia just to build market share there?
That is precisely the risk. It's the fundamental danger of being a minority partner to a sovereign fund. Their priority might be strategic, not purely financial.
So maximizing shareholder return isn't the number one goal.
Not necessarily. Maximizing strategic value for the kingdom could come first. An autonomous CEO might shut down that expensive Saudi factory and just focus on Arizona.
But Winterhoff can't do that.
He does not have that autonomy. He has to run the Saudi operation, even with the inefficiencies, because the mandate from his majority owner demands it. It's a permanent headwind.
So summarizing management. Historically poor capital allocation, but improving candor under Winterhoff. Still, the structural problem of the PIF's influence and myth-aligned incentives remains a huge governance risk. Chapter 3. Financial health. All right, this is where we get into the brutal math. We're going to strip away the hype and look at the cash reality as of December 2nd, 2025.
And we have to start with the single most alarming number, the reason any value investor just stops reading: the negative gross margin.
Let's just define that again, simply, for everyone listening.
Sure. Gross margin is just your revenue minus the direct cost of making your product. Before any R&D, sales, or overhead, it's the profit you make on the thing you actually sell.
And in the auto industry, you want that to be, 20% plus?
Ideally, yeah. Healthy companies are in that range.
And Lucid's Q3 2025 number?
It was catastrophic. They had revenue of about $337 million. Their cost of revenue was $670 million.
Wow. So for every dollar they took in selling a car,
They spent almost $2 just to build it. They are literally selling dollars for 50 cents.
How is that even possible? There are two main reasons.
Two big culprits. The first is fixed cost absorption. Think of it like a 500-room hotel with only 5 guests. Lucid built this massive factory, but they're only making a tiny number of cars. So the cost of that whole factory gets spread over very few units, making each one incredibly expensive.
And the second culprit is newer. It's external, the tariffs.
The 2025 tariff regime, correct. This hit them hard. Management themselves said it was a 13-point negative impact on their gross margin. For a company already struggling, that's just a devastating blow.
Okay, so let's move to the balance sheet.
Yeah.
Because on the surface, it looks okay. They report something like $5.5 billion in liquidity.
Right. And you look at their market cap, about $4.2 billion, and you might think, hey, this is a value play. It's trading for less than its liquidity.
But that's a trap.
It's the biggest value trap. You have to look at the quality of that liquidity. When you dig in, only about $2.3 billion of that is actual cash and investments you can spend tomorrow.
So what's the rest?
A huge chunk, about $2 billion, is a delayed draw term loan from the PIF. And it's critical to understand that this is debt. It's a credit line. Every time they use it, their leverage goes up.
And they just raised more money in November, right? Those green convertible notes?
Another $975 million. But that comes with its own poison pill. It's a double-edged sword of dilution risk.
Walk us through how that works.
Okay, so they get the cash today, which they desperately need. But these notes can be converted into stock later, let's say at a price of $16 or $17 a share.
So if the stock actually recovers and goes up,
The note holders convert their debt into millions of new shares. That floods the market, dilutes existing shareholders, and puts a cap on how high the stock can go.
and what if the stock stays low?
Then it's even worse. In 2031, those note holders will want their money back. All $975 million of it in cash. And for a company burning money like Lucid, that's a potential death sentence.
This brings us to the dilution machine, the August 2025 reverse stock split.
That was the clearest signal of distress they could possibly send. Healthy companies split their stock to make it cheaper. Distressed companies do a reverse split to artificially pump up the price and avoid getting delisted from the stock exchange.
And what's the total damage to shareholders since the IPO?
When you adjust for that split, the share count has basically doubled. So if you were an early investor, your slice of the pizza has been cut in half, just to keep the lights on.
So with all this, how do you even value the company? PE ratios are useless.
Totally useless. You have to look at it like an option. The market isn't valuing Lucid's current business. It's valuing the probability that they survive long enough for the midsize car to be a hit.
And that's why the trading below liquidity argument is such a trap.
It is, because they are a cash incinerator. They burn $700 to $900 million a quarter. You do the math. $5.5 billion in liquidity divided by, say, $900 million in burn.
That's only 6 quarters. A year and a half.
A terrifyingly short runway. It means more fundraising, more dilution is almost guaranteed. The $4.2 billion market cap is the price of a lottery ticket that the PIF will keep them alive until 2027.
You ran a probability model on this. What were the scenarios?
We looked at 3 outcomes. Scenario A is the success case. The midsize car launches, sells 200,000 units a year, and hits a 15% gross margin.
The dream scenario.
Right. We think that's worth about $20 billion, but we only give it a 20% chance. The execution risk is just too high.
Okay, scenario B, stagnation.
This is the most likely. They stay a niche luxury brand, burning cash, propped up by the Saudis. We value that at about $3 billion, with a 40% probability.
And scenario C.
The PIF gets tired of the public market and just takes the company private at a small premium. We value that at $5 billion, also with a 40% chance.
So when you weight all those together,
The weighted average value comes out to about $8 billion.
which is higher than the current $4.2 billion market cap.
It is. So the stock is cheap if you believe in that best case scenario. But it's not wildly undervalued when you factor in the very high probability of just muddling along or being taken private. The market is deeply, deeply skeptical.
Like and subscribe to Stock Analytics AI.
For €4.09 month, get 500 plus deep dive videos on all S&P 500 stocks with NASDAQ 100 coming next. Plus members only requested deep dives. Part 2. Chapters 4 to 7, market sentiment, ownership, risk, and final conclusion.
Chapter 4, Market Sentiment. Right now, we need to look at the external narrative, the story the market is telling itself about Lucid. And right now, the dominant theme is the tariff trap.
It's a huge headwind, and it's largely a self-inflicted wound from their supply chain choices. Those broad-based 25% tariffs that came in after the 2024 election have really hurt them.
And why are they more exposed than, say, a Tesla or a Ford?
Because unlike Tesla, which spent years localizing its supply chain, Lucid still relies very heavily on imported components from Asia. We're talking specialized battery cells, the silicon chips for their inverters.
So they're caught in a squeeze. They have two choices, and both are bad.
An impossible position. Choice A, you eat the 25% cost, but your gross margins are already at negative 100%, so that's not really an option.
Choice B, you raise prices to pass the cost to the consumer.
But these cars are already incredibly expensive.
Yeah.
Raising the price even more would just kill what little demand they have. Investors see this, and they see a company that is uniquely vulnerable.
Let's talk about the retail investor, because that story arc has been just brutal. From the SPAC euphoria of 2021.
Oh, the CCIV days.
Hmm?
The next Tesla.
Yeah.
The hype was incredible.
That is completely gone now.
It's been replaced by exhaustion and resignation. You look at the social media forums, it's not when moon anymore. It's will we survive 2026? The entire conversation has shifted to pure survival.
And that 1-for-10 reverse split was the final nail in the coffin, psychologically.
It was a trauma. It was the moment the company officially went from being a growth stock to a distressed asset in the minds of most retail holders. It just shattered the dream.
How are the Wall Street pros looking at it?
They're firmly on the sidelines. The consensus is hold or neutral. They're all just waiting.
Waiting for the mid-size platform.
Waiting for proof that the mid-size platform can actually be built with a positive gross margin. The average price target is around $19, so there's some upside from here, but no one is willing to put a buy rating on it until they see the numbers.
And the short sellers are circling.
Constantly. The short interest is very high. It tells you that sophisticated traders are actively betting against the stock, or at least hedging their bets. It's a clear signal that the smart money is, at best, extremely cautious. Chapter 5. Ownership structure. All right, in any deep dive, there's always one fact that's more important than all the others. For Lucid, it is this. The Public Investment Fund of Saudi Arabia, the PIF, controls about 60% of the company.
60% of the equity and the voting power. That changes everything.
It has two huge implications. First, no hostile takeovers. You cannot buy Lucid unless the Kingdom of Saudi Arabia says you can.
And second, it creates what the market calls the Saudi put.
Exactly. This is the assumption that because Lucid is so important to their Vision 2030 plan, the PIF will never, ever let it go bankrupt.
So they act as a lender of last resort. It puts a floor into the stock. It won't go to zero.
That's the benefit. But there is a massive corresponding risk on the other side, the privatization risk. We call it the ceiling risk.
Let's unpack that, because it's the biggest risk for anyone speculating on this stock.
Okay, so imagine the stock keeps struggling. It drifts down towards $10 a share. The PIF, which has this very long-term strategic view, might just decide that dealing with public shareholders is a hassle they don't need.
So they could just buy the rest of it.
They could announce an offer to take the company private. They'd offer a small premium, maybe $13 a share. For them, it's a bargain to get 100% control of the tech.
But for the retail investor who bought at $50 or $100 pre-split,
It locks in a permanent catastrophic loss.
it's that Buffett warning again. It's dangerous being a minority partner when the majority partner has completely different goals.
Absolutely. Beyond the PIF, what about the other insiders, the executives?
That's another huge red flag. You see a consistent trend of net selling or just no activity at all.
No major open market buys from the CEO or the CFO. You're not seeing the people who know the most about the company putting their own money on the line. That tells you a lot.
And the big institutions, the Vanguards and BlackRocks.
They're mostly passive holders at this point. They own it because it's in an index. The active managers, the stock pickers, they've largely fled. There's just too much uncertainty. They've rotated out, and that's kept a lid on the share price.
Chapter 6. Risk assessment. Okay, so let's put this all together into a classic SWOT framework. Strengths, weaknesses, opportunities, and threats. This should give us a clear picture of the risks.
Let's start with the strengths.
Yeah.
And they are all internal. They are all about the technology. First and foremost is that engineering lead.
We said it's probably 3-5 years ahead of the competition on pure efficiency. That 5 miles per kilowatt hour metric is just untouchable right now.
Second strength is product excellence. The cars themselves are fantastic. The air, the gravity, they get rave reviews. The problem is the business, not the product.
And the third strength is the big one: sovereign backing. The PIF is a lifeline that other failed EV startups just didn't have.
Now for the weaknesses. These are the financial killers we've been talking about. Number one, the unsustainable cash burn.
$700 to $900 million a quarter.
Number two, the negative gross margins. The core business is upside down. And number three, a lack of brand awareness. They just don't have the cultural footprint of a Tesla or a Mercedes.
All right, what about the opportunities? This is the bull case. What could go right?
The most interesting one, I think, is technology licensing. The Aston Martin deal was the proof of concept.
Right, where they're supplying their powertrain tech to Aston.
If they could pivot and become more of a high-margin, tier-one supplier of EV tech to other car companies, that would completely change their financial profile.
And the biggest opportunity, of course, is the midsize market.
It's the whole ballgame. That $50,000 car opens up a market that is 10 times bigger than the luxury segment they're in now. It's their only shot at real volume.
And maybe some energy storage on the side, like Tesla's Powerwall.
A smaller opportunity, but it's there. But now we have to face the threats, the big external factors. The biggest one is the 2025 tariff regime.
Which could permanently damage their margins because of their reliance on imported parts.
Correct. Then you have persistently high interest rates. That makes it more expensive for them to borrow money and more expensive for customers to get a car loan.
And finally, just brutal competition.
By the time their midsize car launches in 2027, that $50 K segment will be a war zone. You'll have the Rivian R2, the Mustang Mach-E, new cars from Hyundai Kia. It is going to be incredibly crowded. Chapter 7, Conclusion. So we come all the way back to our central question. Based on everything we know in December 2025, would a disciplined value investor, a Warren Buffett type, buy this stock?
And after all this, the answer is still a clear, emphatic NO.
An unqualified no. It fails every single test. No consistent earnings, negative return on equity, management isn't truly autonomous, and it survives on external funding.
There's no margin of safety.
Zero. When your cash runway is measured in quarters, not years, you're not investing, you're gambling.
So let's define that gamble one last time. For the speculator, the person who is willing to take that bet, what are they actually betting on?
It's a very specific two-part bet. One, that the PIF's political will is strong enough to keep writing checks until 2027. And two, that the technical team can actually launch that midsize car on time and, crucially, with a positive gross margin.
And what are the odds on that bet?
The downside is probably protected by that Saudi put, but the upside is severely capped by the dilution from those convertible notes. It's like you said before.
A technological diamond wrapped in a financial straitjacket.
They've conquered physics. They're still fighting economics.
What would it take for you to change your rating? Is the one thing you need to see.
Two things. First, I need to see a real, sustainable, positive gross margin, proof that the core business works. And second, I need the interim tag taken off the CEO's title. I need to see long-term, stable leadership focused on execution.
A deep dive indeed. Thanks for laying it all out.
We'll leave you with one final thought to chew on. That old saying, price is what you pay, value is what you get. With Lucid, you're paying a premium price for a very high-risk option on a future that is still very much in doubt, a future that depends more on political will than on business fundamentals.
If you found this analysis insightful and thorough, please like and subscribe to Stock Analytics AI.
And remember, for $4.99 a month, you can get access to 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives just like this one.
A quick, important note. This deep dive is based on AI research public source material from December 2025 and is provided for informational purposes only. It is not financial advice, and we strongly encourage you to conduct your own due diligence and consult with a professional advisor before making any investment decisions.